Silver didn't climb to $90. It broke through something far more important. In a matter of weeks, silver didn't just rise, it accelerated from around $50 an ounce to $90 with almost no resistance in between. No long consolidation, no orderly pullbacks, just vertical movement. That kind of speed doesn't come from optimism, it comes from absence. When prices move that fast, it means sellers aren't stepping in, liquidity vanishes, and the market stops negotiating. If you've ever assumed that commodity prices rise because demand slowly increases, this should make you uneasy, because this move wasn't gradual, it was violent, and it caught institutions off guard, even those who had been bullish for years. Silver didn't enter a normal bull market, it entered a vacuum, a moment where buyers rushed forward and discovered there was nothing on the other side. That's why $90 matters. Not as a number, but as a signal. It marks the point where the old pricing structure stopped working. And here's the part most people missed. This move wasn't driven by speculation. It was driven by something being cut off. What pushed silver into that vacuum wasn't a chart pattern or a sudden burst of enthusiasm. It was a structural shock that most headlines barely touched. At the start of this year, China quietly changed the rules. Silver exports didn't stop outright, but they were no longer automatic. Every shipment now required direct state approval. That single move introduced friction, where the global system depends on flow. And because China isn't just a consumer, but a major refining hub for silver mined around the world, that friction mattered immediately. This wasn't about domestic supply. It was about control. When refined metal can't move freely, availability collapses far beyond one country's borders. Western buyers weren't just competing with higher prices, they were competing with permission. Notice how fast the market reacted. The jump from 50 to 90 didn't unfold over quarters. It happened as industrial users and traders realized something critical. Silver that used to be reachable might not be reachable tomorrow. Here's the question that reframes everything. If a single policy decision can remove that much metal from circulation overnight, how stable was the supply chain to begin with? Because once access becomes conditional, price stops being theoretical. And that's when panic starts doing the bidding. Here's where the story widens, and the pressure compounds instead of relieving. The supply shock didn't land in a calm world, it landed in one already sliding toward instability. Governments were already rattled, alliances were already strained, and suddenly the background noise turned into something louder. Arrests of heads of state, military posturing, open talk of conflict instead of diplomacy. Capital didn't need convincing, it reacted on instinct. This is how a war premium sneaks in, not through a single headline, but through accumulation of fear. When investors stop trusting borders, treaties, or timelines, they move toward assets that don't rely on anyone else's promise. Silver benefits not because it's trendy, but because it exists outside the system that's showing cracks. But here's the part that changes the interpretation. Even with all that geopolitical noise, this rally didn't behave like a typical safe haven spike. It didn't fade when headlines cooled. It didn't pause for reassurance. It kept climbing. That tells you fear wasn't the root cause, it was an accelerant. The fire was already burning underneath, fed by something deeper than politics. And once you see that, the next layer becomes unavoidable. The deeper driver isn't conflict, it's math. Long before silver broke upward, the financial system was already boxed in by debt it cannot repay. Governments didn't just borrow too much, they structured their entire economies around rolling that debt forever. And the only way that works is if the currency used to repay it keeps losing value. That's the quiet force behind this move. When money supply expands faster than real output for long enough, hard assets don't rise. Currency falls around them. Silver's move to 90 isn't a surprise in that context. It's a delayed reaction. Look at the pattern. Every major expansion in precious metals prices has followed a surge in monetary creation, not immediately, with a lag, years sometimes. What you're seeing now is the catch-up phase when markets finally admit what the numbers have been saying all along. This is where the story flips, because once the market accepts that debt will be serviced through devaluation, holding cash becomes a guaranteed loss, and assets that can't be printed stop being optional. That's why this move feels different. It isn't chasing growth, it's escaping erosion. And that realization is what pulls the next group of participants in, the ones who don't trade headlines, but balance sheets. Here's where the disconnect turns into an opportunity most people don't see yet. While silver itself exploded upward, the companies that mine it barely moved. Stocks tied to silver production are still being priced as if the metal were $40 or $50 an ounce. That gap isn't subtle, it's extreme, and it only exists because the price moved faster than models can update. Markets don't instantly reprice businesses. Analysts wait for earnings. Institutions wait for confirmation. Capital waits for permission. That lag creates a vacuum of its own. Right now, silver producers are selling the same product for nearly double the price, while their valuations still reflect the old world. This is not how cycles end, it's how they begin. Historically, money moves in a sequence. First into the metal, then into producers, then into developers, then into explorers. We are still stuck in the first step. The rotation hasn't happened yet. Here's the line that permanently reframes this. If silver stays anywhere near 90, when companies report their next results, the math breaks every conservative assumption the market is using right now. And once that math is visible on balance sheets, capital doesn't debate it. It rushes. Once that rotation begins, the shock isn't subtle. It's mechanical. Mining is a fixed cost business. Labor, energy, equipment, most of it doesn't double just because the metal price does. So when silver moves from 40 to 90, that extra $50 doesn't disappear into expenses. It drops straight to profit. Margin expansion at that scale doesn't creep in. It snaps. That's what the next earnings cycle threatens to reveal. Cash balances balloon. Debt evaporates. Free cash flow appears where models predicted scarcity. Companies that were treated as marginal suddenly look overcapitalized. This is where consensus gets blindsided. Analysts don't miss trends, they miss speed. And this speed rewrites valuation logic almost overnight. Dividend capacity changes, buyback math changes, acquisition power changes. Here's the part most people underestimate. This isn't just about better earnings, it's about optionality. With cash comes control. Control over timelines, control over development, control over who survives the next consolidation wave. Once producers demonstrate what $90 silver actually does to their margins, the conversation stops being speculative. It becomes unavoidable. And that forces the next strategic shift, one that reshapes the entire junior sector. That shift is already happening, quietly and fast. Companies that once behaved like explorers are changing posture. When prices were low, the goal was discovery. Prove the resource exists. Expand ounces. Stay alive. But at $90 silver, discovery is no longer the bottleneck. Execution is. Projects that were uneconomic a year ago suddenly cross viability thresholds. Marginal deposits turn into strategic assets. Timelines compress. What used to be someday moves into now. Exploration continues, but alongside permitting, engineering, and economic studies, parallel motion replaces patience. This is where junior companies either evolve or disappear. The ones that pivot toward development start speaking a different language. Capital efficiency, buildability, scale. They stop selling stories and start selling pathways. And here's the critical detail. This shift isn't optional. When metal prices explode, the market stops rewarding potential and starts demanding readiness. Assets that can't move forward get left behind, regardless of how exciting the geology looks. That pressure reshapes entire portfolios. Multi-project strategies emerge. Optionality becomes leverage. And the companies that adapt first gain something more valuable than ounces. They gain time. Where this plays out matters as much as the price itself. Not all jurisdictions are equal when markets tighten. In a world drifting toward resource nationalism, location becomes a form of insurance. Projects in unstable or hostile regions don't gain value when prices rise. They gain risk. Capital avoids them. Timelines stretch. Permits stall. That's why established mining regions suddenly matter again. Places with infrastructure, history, and operating know-how. Districts where teams already understand the ground, the regulators, and the communities. In those regions, higher prices don't just improve economics, they unlock them. This is where dominance shows up quietly. Large consolidated land positions, multiple deposits in the same belt, shared infrastructure, experience that can't be replicated quickly. When capital rotates into the sector, it doesn't scatter evenly. It concentrates where execution risk is lowest. Here's the subtle shift most people miss. As prices rise, scarcity doesn't just apply to metal, it applies to viable projects. And when that realization hits, valuation stops being about ounces alone. It becomes about jurisdiction, control, and speed. And that sets up the next transformation, the one that turns resources into targets. At that point, attention narrows onto the assets that can actually carry the weight. High-grade systems start behaving differently in this environment. They don't just benefit from higher prices, they amplify them. When grades are strong and continuity is proven, every extension matters more. Each drill result doesn't just add ounces, it adds confidence that the system scales. This is where flagship projects separate themselves. Deep extensions hold. Veins widen instead of pinching out. Step-outs keep hitting. The story shifts from "is this real?" to "how big can this get?" And that question attracts a different class of capital. Because scalability changes everything. It suggests longevity. It suggests standalone potential. It suggests that what's being built isn't a trade but a mine that can anchor production for years. Now notice the timing. These confirmations are arriving after the price has already repriced, which means the geological proof is landing into a market that's suddenly paying attention. That alignment rarely lasts long. Once a project demonstrates both grade and scale under a high-price regime, it stops being optional. It becomes strategic. And that leads directly to the next phase, where sleeping assets wake up fast. Some assets don't need discovery. They need a price. Large, previously sidelined projects fall into that category. For years they sat ignored, not because the metal wasn't there, but because the economics didn't work. At $30 or $40 silver, margins were thin, timelines were long, the risk wasn't worth it, so the market priced them at zero. At 90, that logic collapses instantly. Projects that once required heroic assumptions now clear feasibility with room to spare. Infrastructure already exists. Drilling is already done. The only missing ingredient was price. When that ingredient arrives, value doesn't creep back in. It snaps. This is where the repricing feels unfair. A deposit the market dismissed for a decade suddenly becomes central. Studies get dusted off, permits get reopened, development schedules compress. What looked like optionality turns into inevitability. And here's the key detail. These assets don't need years of exploration to unlock value. They need confirmation of what the market already sees on the screen. When that happens, valuations don't adjust politely. They gap. At this stage, execution becomes the only question that matters. When prices move this fast, the market stops forgiving weak leadership. It doesn't care about vision statements or long-term narratives. It wants proof that the people in charge have done this before, that they've taken assets through cycles, not just talked about them. This is where track records suddenly carry weight. Teams that have built mines, navigated downturns, and sold companies at the right moment stand apart. They understand timing, they know when to advance, when to wait, and when to force the issue. That experience becomes a form of leverage, because in a rising market, mistakes get amplified. Capital floods in, but it also leaves fast. The difference between value creation and value destruction often comes down to a handful of decisions made under pressure. Here's the subtle but critical shift. As prices rise, investors stop asking, what do they have? And start asking, can they execute? Assets don't disappear, but credibility does. And when credibility concentrates around a small group of operators, the end game becomes visible. It's no longer about building forever, it's about who takes over. That's when consolidation stops being a theory and starts becoming a necessity. Large producers can't survive on price alone. They need reserves. And right now, reserves are disappearing faster than they can be replaced. Years of underinvestment left balance sheets strong, but pipelines thin. When prices explode, that imbalance becomes a problem that can't be solved internally. So the logic turns outward. Acquisitions become the fastest path forward. But not just any acquisition. The targets that matter are the ones that are already de-risked, permits advancing, studies underway, infrastructure understood, projects that don't require a decade of patience. This is why preparation changes bargaining power. A company that can build doesn't have to sell. That single fact reshapes negotiations. Buyers know it, sellers know it, premiums rise when optionality is real. Here's the final insight. The silver move to 90 isn't creating opportunity out of thin air. It's revealing which assets were always valuable and which ones were placeholders waiting for a story. As volatility settles, a new floor will form, not at old prices, at levels that permanently alter feasibility. Silver didn't just reprice, it reset the board. If you want to understand how this reset spreads beyond silver into equities, currencies, and the next phase of capital rotation, stay with the channel. This story is just getting started.